So, all right, so we got a topic today for financial segment. Obviously, Jerry and I on the show on I Love CVille on Tuesday, we were talking a little bit about just things that were happening, predictions, inflation, hyperinflation, how are things going, that little Twitter spat between Kathy
Dorsey
Wood
and
of ARK
Kathy Wood.
Investments and Jack Dorsey, the CEO of Twitter. But one of the topics that came up, of course, are what are we seeing in the market in terms of not just the markets, but the economy as a whole. What are some leading indicators you and I are looking at? What are the signs? As Jerry was talking, obviously he and Keith talked a lot about real estate. So he and Keith were, I guess, seeing some signs that were not as good in real estate as they've been so far. And we were just talking a little bit about what we're seeing and what that kind of portends for the economy and our crystal ball for 2022, as difficult as the crystal ball is.
Well, and this is all very interesting because, part of what's happening in the economy, right, is a combination of very expensive energy prices, right, which is always a problem. And the other thing that's interesting is the fact that when you talk about real estate, it's the rise in interest rates, right? And so we've seen the 10-year go up by about 50 or 60 basis points, and mortgage rates are linked off the 10-year Treasury, right? So of course, as interest rates rise, the cost of your house then becomes a little higher because in the sense that you're going to pay a higher interest rate. So all that gets tied together. This is, and I always say, you look back in history and say, okay, where are we, and how can we go back and say, okay, here's the stage we are in this particular situation because that's how it was back in 2008, 2006, or before that, 1998, whatever. The issue is that every single recession is really different. In other words, the catalyst to that recession is different, right? And we are really, faced with a situation here that is somewhat confusing, right? And it's never happened before. And if you take a look at, I grew up with the bond market, right? And the yield curve is a great predictor of things that may happen, right? And if you look at the yield curve over the last month and a half, it's been chaotic, right? And so last week we even talked about how, you began to see that long-term rates were separating themselves from short-term rates and also from stocks. And this past week has been a complete reversal. The spread between, the 5-year Treasury and the 30-year Treasury, right? That whole area has begun to flatten. And even though it doesn't seem very much, the 3-month T-bill, for example, has gone up from like 0.02 to 0.06 for no reason. In other words, that won't move unless you think or unless the Fed is going to act, right? And so you sit there, you go, all of a sudden, short-term rates seem to be going up a little bit, right? And long-term rates, in a very short week, and long-term rates have come down, right? And so you say, well, is it because people think that that's the end and therefore they want to take advantage of the long-term rates, or is it something else? And I just think that people are very nervous, right, about what is happening.